Welcome back to Market Matters Media. I'm thrilled to have you here as we delve into the pressing issue that has gripped the world's attention over the past few weeks. In this video, we will unravel the intricate web of events surrounding the Ukraine and Russia conflict and explore its profound implications on the global economy. So grab a seat and let's dive into the market matters that truly count. In recent weeks, the global financial landscape has been dominated by growing concerns over the potential escalation of conflict between Ukraine and Russia. These geopolitical tensions have sent shockwaves through the world economy, and in this video we will delve into the current state of the US economy, examine ongoing and forthcoming changes, and explore strategies for US investors to optimize their portfolios in these uncertain times. The invasion of Ukraine by Russia has triggered alarm and apprehension on a global scale, with far-reaching consequences that extend beyond the borders of the two nations. Notably, the European Union's decision to supply Ukraine with weaponry worth $500 million represents a historic departure from its previous actions. This move underscores the gravity of the situation and the unprecedented nature of the conflict. Additionally, a multitude of other nations have become embroiled in the conflict, evoking memories of the Cold War era. The prevailing consensus among experts is that Russia possesses superior military capabilities and is likely to emerge victorious in this conflict. Should Russia prevail, it may lead to a shift in Ukraine's political landscape, potentially aligning the country with Russia. However, questions linger about the duration of resistance following a change in the government. Many anticipate the resurgence of a new Cold War era characterized by fortified borders and heightened militarization. Nevertheless, the specter of military escalation continues to loom over the region, creating uncertainty that may persist for an indeterminate period. The imposition of economic sanctions on the Central Bank of Russia further complicates the global economic outlook. To gain a better understanding of the changes that lie ahead for the US economy, it is essential to assess its current position. Recent economic indicators portray the US economy as operating at full throttle. Unemployment rates have reached a near 52-week low, wages are on an upward trajectory, and consumer spending is surging due to the expansive money supply. Over the past 2 years, M2 money supply, which measures the circulating currency within the economy, has witnessed a substantial increase, effectively boosting the US GDP. However, this surge in M2 is also contributing to rising inflation, which has been exacerbated by supply chain disruptions. It is worth noting that the value of the US dollar in foreign currency markets has remained relatively stable. This stability can be attributed, in part, to the fact that other countries have also engaged in extensive money supply expansion. As the M2 money supply continues to grow, it exerts upward pressure on commodity prices, impacting consumers who are grappling with higher costs. Central banks across the globe have adopted a hawkish stance in response to the rising tide of inflation, with the objective of curbing it before it becomes a prolonged and entrenched issue. This shift in central bank policy has significant implications for the financial markets. The stock market, for instance, is anticipating between 4 to 6 interest rate hikes by the US Federal Reserve. Each rate hike raises interest rates across the economy and reduces the money supply. Initially, it was expected that the Fed would raise rates by 50 basis points or equivalent to 0.5% in March. However, the ongoing conflict has prompted a postponement of this option, with the possibility of a 50 basis point increase later in the year. Goldman Sachs, a prominent financial institution, has forecast an unprecedented 11 rate hikes by the Fed in 2023. Such a substantial increase in interest rates could potentially lead to a recession in that year. Additionally, the Federal Reserve is poised to embark on a process known as quantitative tightening, which involves the sale of bonds. This stands in stark contrast to the quantitative easing measures that were initiated in early 2020 when the Fed purchased bonds to stimulate the economy. Quantitative has the effect of reducing the money supply in the economy, ultimately affecting demand. Delaying these measures runs the risk of spiraling inflation getting out of control. The conflict in Ukraine and the resultant sanctions imposed on Russia have had a notable impact on commodity prices, particularly in the realm of oil and natural gas. This has, in turn, led to a temporary slowing of economic activity as consumers allocate a greater share of their income to meet energy and food expenses. Russia's invasion of Ukraine caused a surge in oil prices, pushing them from their usual range of $70 to $80 per barrel to briefly surpass $100 before receding to the 90s. Russia plays a pivotal role in supplying oil and natural gas to Europe, with Ukraine serving as a critical transit point for these resources. The potential disruption of pipelines, along with the imposition of sanctions, has the potential to reduce the supply of these essential energy resources. Moreover, Ukraine is a significant global wheat supplier, contributing to 14% of the world's wheat supply, a significant portion of which is exported to Europe. Consequently, the invasion's impact on food and energy prices in Europe is substantial, potentially driving prices higher. A decrease in oil and wheat supply in Europe may necessitate the redirection of supply from the United States to Europe, leading to increased prices domestically. This interconnected relationship underscores the global linkage of prices. The sanctions imposed on Russia have primarily targeted the financial and technology sectors. However, these measures have not gone so far as to cut Russia off entirely from the SWIFT payment system, which serves as the international platform for settling accounts and transferring money among banks. Immediate expulsion of Russia from SWIFT would hinder European banks' ability to fulfill their debt obligations to Russian counterparts, particularly concerning gas and oil purchases. While additional sanctions targeting SWIFT are anticipated, economists expect that at least one bank will retain access to SWIFT to facilitate European payments to Russia. Consequently, the persistently elevated energy and food prices pose a complex challenge for central banks across the globe, with the potential to exacerbate long-term inflation concerns. To mitigate the impact of rising prices, the U.S. and other nations may consider releasing a portion of their strategic petroleum reserves. This move could temporarily push oil prices back into the range of $70 to $80 per barrel. However, significant investment in oil production is unlikely at this juncture, given the ongoing political tensions and the uncertainty surrounding future price movements. Oil manufacturers are wary of embarking on drilling projects at $90 per barrel if prices may potentially drop to the $70 to $80 range in the near term. The current landscape is characterized by its fluidity, with daily developments continually reshaping the situation. Given the multitude of factors in flux, it is advisable to closely monitor market volatility. As we navigate these uncharted waters, your engagement is invaluable. Share your insights and perspectives in the comment section below. How do you envision the evolving economic landscape in the aftermath of the Ukraine crisis? Your contributions enrich the collective understanding of these complex dynamics. Before we wrap up, a friendly reminder to subscribe to Market Matters Media if you haven't already. Hit the like button if you find this information valuable, and stay tuned for more in-depth analysis on the economic impacts of global events. Thank you for being part of our community, and I look forward to engaging with you in the next installment.